Welcome to Talk Tickers, your go-to for earnings call summarization.
Glad to be here.
Today, we're diving into the second quarter fiscal year 2025 earnings for Natural Grocers by Vitamin Cottage.
And this one definitely caught our attention.
Yeah, it wasn't just, a standard update. Management used words like exceptional, record sales, record earnings.
And the big news out of that, they actually raised their financial outlook for the whole fiscal year.
Which, as you said, tells you something significant is happening there. You don't do that lightly mid-year.
Exactly. It points to real confidence in the underlying business momentum. So let's unpack what drove this quarter.
Okay, let's hit those key numbers first. Q2 FY25 versus last year. Net sales saw a really robust increase, up 9% to $335.8 million.
Solid top-line growth. But the comparable store sales number is particularly strong.
Right. Daily average comparable store sales grew an impressive 8.9%.
And get this, the two-year stack, looking back 2 years, that accelerates to 16.4%.
Wow. So that's sustained accelerating growth. Pretty rare these days, especially in retail.
Very rare. And the way they achieved it is key. It wasn't just higher prices, though that played a small part.
So what was the main driver?
It was a combination. First, transaction count was up 5.9%. That's more people coming in.
Okay, and that's the 9th straight quarter of positive traffic for them?
9th consecutive quarter. That's huge. And the daily average transaction size was also up by 2.8%.
Which is the 5th quarter in a row for that metric.
Right. So you've got more people walking in the door, and those people are, on average, buying more each time they visit. That's the ideal scenario.
That combination definitely points to healthy underlying demand, and it looks like it flowed through to the profit lines, too.
It sure did. Gross margin improved by a full percentage point, 100 basis points, landing at 30.3%.
And operating income.
Big jump there. Up 55.9% to $17.6 million. That pushed the operating margin up 150 basis points. Real operating leverage.
Yeah, when sales grow that strongly, you often see that leverage. Costs don't rise as fast.
Exactly. And it drops straight to the bottom line. Net income was up 64.6%, $13.1 million.
And earnings per share.
Diluted EPS rose 60% to $17.56. Adjusted EBITDA, another important one, up 33.3% to $26.3 million.
So strong performance pretty much everywhere you look on the P&L. How about the balance sheet?
Looked solid. They ended the quarter with cash, no outstanding debt, and they mentioned healthy free cash flow in the first half.
Good foundation.
Very. So you take all that together, the strong sales, the traffic growth, the margin expansion, the healthy balance sheet.
And it leads back to that raised guidance.
Precisely. They felt confident enough based on these Q2 results to bump up their full-year targets for both comparable store sales growth and earnings per share. A significant vote of confidence.
Okay, let's dig a bit deeper now. What exactly was behind these numbers, that transaction size increase, the 2.8%? How did that break down?
Yeah, management gave some color on that. They said approximately 1 percentage point came from people putting more items in their basket.
Okay, so actual unit growth per transaction.
Right. And the other, roughly 2 percentage points, that was attributed to modest product cost inflation being passed through.
Got it. So a mix. But importantly, customers were actually buying more things.
Exactly. And this strength wasn't just concentrated in their newer stores either.
Oh, that's interesting. What did they say about store vintages?
They specifically highlighted strong performance across all store ages. Even the mature stores, ones open 5 years or more, saw an 8.5% comparable sales increase.
That's impressive. It suggests the core model is really resonating, not just the honeymoon period for new locations.
Absolutely. It speaks to relevance and loyalty over time. They also saw strength across product categories.
Especially in their more unique offerings, right?
Yes, particularly the ones where they have those really high standards that differentiate them.
Like what specifically?
Things like their meat, it's all humanely raised, sustainably sourced to their specific definitions. Produce is 100% organic, no exceptions. Dairy is 100% pasture-raised, and they have minimum standards for free-range eggs.
So these aren't just labels, they're backed by strict sourcing standards.
Right. And they believe that really resonates with their core customer who's focused on health and wellness. Those categories saw the highest growth.
And this momentum, it wasn't just a Q2 blip.
Apparently not. Management stated these trends were consistent through the whole second quarter and, importantly, have continued into Q3.
Okay, so the strength seems to be carrying forward, at least initially. Now, turning to profitability, that gross margin bump, what was the driver there?
They primarily pointed to effective promotions. So it sounds like they ran successful offers that drove volume without sacrificing margin too much, maybe even helping it.
Smart promotional activity then.
Seems like it. And on the expense side.
Store expenses actually decreased as a percentage of sales.
Right, that's the operating leverage you get. Higher sales spread over a relatively fixed store cost base.
Makes sense. But admin expenses went up slightly as a percent of sales?
They did. They attributed that to investments, specifically in technology, and also higher compensation costs at the corporate level.
Okay, so some strategic spending there offsetting a bit of the store level leverage.
Exactly.
So pulling back, what's management's overall take? Why do they think they're succeeding like this right now?
They really believe there's this ongoing, fundamental shift where consumers are prioritizing health, wellness, food, nutrition, and they see Natural Grocers as perfectly positioned to capture that demand.
They also mentioned their value proposition, right?
Yeah, they talked about their relevant value offering, high quality, natural, and organic stuff, but at prices they feel are affordable and competitive. They think that's attracting new customers.
And keeping existing ones engaged.
Definitely. They highlighted enhanced customer engagement through marketing, specific offers, and particularly their Empower Rewards program. They see that loyalty program as really instrumental.
That program seems pretty central.
It does. And overall, they expressed confidence they can navigate the uncertain economy. They feel their customer base is diverse and that spending on health and wellness is maybe less discretionary for their shoppers.
Let's talk more about that Empower Rewards program. Penetration increased, you said?
It did. Up to 81% in Q2. That's up from 78% last year. That is a very high engagement rate for a loyalty program.
81%. Wow. What makes it work so well? Did they give details?
Yeah, in the Q&A, they went into it. It's not just about earning generic points. Members get individualized offers based on what they buy.
Ah, personalization.
Right. Makes people feel like the offers are relevant. And the points they earn when they load those offers work out to roughly a 1% rebate. Plus, and this is key, you have to be an Empower member to get the absolute best price on certain staples, like eggs and avocados.
That's a smart way to drive signups and usage. Force people in for the best deals on things they buy regularly.
Exactly. And all their other in-store specials are tied to the program, too. It really locks people into that ecosystem.
Seems like a powerful loyalty driver. What about their own brand, the Natural Grocers brand products?
That's a slight uptick, too. Accounted for 8.6% of total sales, up just a touch from 8.5% year over year.
Still growing, though.
Yeah, and they're actively developing it. They launched 22 new private brand items just in Q2, and they said there are more coming. That's good for margins and differentiation.
And store growth. They opened a couple.
2 new stores in Q2, both in Texas, Brownsville, and Waco.
But they adjusted the full year plans slightly.
Right. They trimmed the outlook for this fiscal year from opening 4-6 stores down to 3-4.
Okay. Any reason given?
Not explicitly for the trim, but they did reiterate their longer-term goal of 6 to 8 new stores per year. And interestingly, they mentioned in the Q&A they're planning to enter a new state soon. An announcement is expected in the next couple of months.
Oh, expanding their geographic footprint. Okay.
So the near-term number is slightly lower, but the future pipeline still sounds active.
Now, the big question everyone asks these days, the macro environment. What did they say about the consumer? Seeing any stress?
They said what you'd expect, they're monitoring trends closely. But here's the key part. They explicitly stated they have not observed indicators of softer demand, customers trading down, or putting fewer items in their baskets. Not yet, anyway.
So despite all the headlines about consumer pullback, they're not actually seeing it in their stores to date.
That's what they reported. They acknowledge the uncertainty out there, but their actual customer behavior right now isn't reflecting those broader negative trends.
Okay, that's a really important data point. Let's pivot now. For you listening, potentially as an investor, what are some takeaways here?
Well, first off, that consistent, strong, comparable sales growth driven by both traffic and basket size over multiple quarters, that's a really powerful signal.
Especially in this environment.
Exactly. It suggests this specific business model, their niche, is highly relevant and resonating strongly right now, maybe more so than broader retail.
And the profitability piece, improving gross margin while leveraging store costs, even with those admin investments, points to strong execution, right?
Absolutely. They're managing the business effectively, growing sales profitably, not just chasing revenue.
And the decision to raise guidance for both comps and EPS.
That's management putting their money where their mouth is, essentially. It signals real confidence that this isn't just a one-quarter wonder. They believe the momentum has legs.
Though they did temper expectations slightly for the second half.
They did. Let's recap those updated numbers. New stores slightly fewer this year, 3.4 instead of 4.6. But comps guidance up to 7.5% from 5.7%, and diluted EPS guidance significantly higher, $1.78 and $1.86, up from $100.57, $1.65.
So stronger performance from existing stores more than offsetting fewer openings this year.
That seems to be the implication. They did caution comps might moderate in the second half, partly because they'll be up against really tough comparisons from last year.
Right, the lap gets harder.
Exactly. And their guidance naturally incorporates some buffer for uncertainty around tariffs, the macro picture, things like that.
What about margins going forward?
They expect gross margin in the second half to be roughly flat to be slightly lower year over year. Depends mainly on how much they invest in promotions.
Okay. And store expenses.
Expected to be relatively flat to slightly lower as a percentage of sales. So continued cost discipline, potential for leverage if sales hold up.
Got it. And there are a couple of interesting operational nuggets from the Q&A too.
Yeah, a couple of quick ones. In-stock levels are good, around 97%. Basically back to pre-pandemic levels. So the supply chain seems to be running smoothly despite the higher demand.
That's important for keeping shelves full and customers happy.
Definitely. And they talked about Instacart for pickup and delivery. It's holding steady at about 2% of their sales.
And they're sticking with the third-party model?
Yes. They said they've analyzed bringing it in-house and concluded it just wouldn't be profitable for them to operate themselves. So they'll continue using partners like Instacart.
Pragmatic approach. Stick to what works for their model.
Right. And maybe one of the most intriguing comments from the Q&A was about who's shopping there.
Ah, the customer demographic piece.
Yeah, they specifically mentioned seeing a pickup in millennial customers.
Oh, interesting. Why do they think that is?
They believe millennials are drawn to what they call their authentic messaging, the focus on health, wellness, sustainability standards.
So the brand values are resonating with that younger, health-conscious group.
Seems so. And that's contributing to the traffic growth. If they're successfully attracting millennials, that's a really positive sign for long-term growth and relevance.
Definitely a potential tailwind. Okay, before we wrap, it's time for our not financial advice segment.
Right, where we brainstorm a potentially outrageous but maybe plausible trade idea inspired only by the information in this specific earnings call. Think hedge fund pitch based on just this quarter's data.
And let's hammer home the disclaimer. This is purely illustrative. It's an intellectual exercise based only on this call. Absolutely not financial advice. Do your own research. Talk to a professional. Seriously.
Couldn't say it better myself. Okay, disclaimer delivered.
So the pitch idea for today. The resilient niche outperformance play.
Okay, I like the sound of that. What's the core thesis?
The argument is this. Forget the general gloom about the consumer. Forget thinking all grocery is the same low-margin slog. Natural Grocers' Q2 results. They scream unique resilience. It's rooted in their specific health niche and what looks like incredibly strong customer loyalty.
So the idea is they're not just a grocer, they're operating a different, more protected space.
Exactly. A space that might allow them to significantly outperform the more commoditized traditional grocery players, almost regardless of what the broader economy does.
Okay, bold. What's the evidence from this call to back that up?
Well, you've got the persistent, strong, positive traffic 9 quarters and positive basket growth 5 quarters. Management explicitly saying they haven't seen trade down yet. They raised full-year guidance despite macro uncertainty. Growth is strongest in their most differentiated, high-standard stuff. They're attracting millennials. And that loyalty program penetration is sky-high at 81% and growing, with real, tangible benefits driving it.
That's quite a list of positives from just one call.
Right. So the proposed trade, leaning into the outrageous conviction based on one data point idea, you go long Natural Grocers, NGVC, high conviction.
Okay.
And the other side.
You simultaneously short a basket of maybe less differentiated traditional grocers or perhaps a broader retail ETF.
A pair trade, betting on the divergence.
Exactly. The outrageous part is the conviction based only on this Q2 call's evidence that NGVC's niche, execution, and customer loyalty create this insulation layer that basically guarantees significant outperformance. It's a bet that this quarter proved their model is fundamentally more durable against economic swings than the market assumes.
It's definitely taking the call at face value and running with it. A high conviction bet on differentiation and resilience shown right now.
An aggressive interpretation for sure, based on perceived unique strength in these numbers.
Okay, interesting thought experiment.
So let's quickly recap the main takeaways from our deep dive into Natural Grocers' Q2 call. Record results. Really strong comparable sales driven by both more shoppers and bigger baskets.
That strength flowed through to margins and profits, leading them to significantly boost their outlook for the rest of the fiscal year.
They're executing on their strategy. The loyalty program is clearly working. They're expanding their private label, and store growth continues, including plans for a new state soon.
And while they're watching the economy like everyone else, their business, at least in Q2, showed remarkable resilience with strong operational performance backing it up.
And one last time, this discussion was based purely on the earnings call information. It is not financial advice.
Okay, let's leave you with a final thought to chew on. Natural Grocers keeps putting up these strong numbers, growing traffic, bigger baskets, attracting younger customers with its specific focus on high standards and value. Does this signal they've actually built a business model that's, well, more recession-resistant or at least more durably growing than your average grocery store?
Could this focus on authentic health and wellness create a sustained growth premium, maybe even independent of the broader economic cycle?
Something to consider as you watch Natural Grocers going forward.